Sentiment toward the year, USD remains gloom, with a high dose of uncertainty ahead. US April inflation will be out this week, but does it matter? So, the Fed was less hawkish than expected, the non-farm payroll report disappointed, Treasury yields retreated, stocks plunged, and yet, the dollar is the overall winner across the FX board for a third consecutive week. What happened? Why is the market moving in the wrong direction? Well, things are not as bad as the headlines indicate. The Fed may have been less hawkish, but it's still on the tightening path. It's just that, policymakers introduced that tinny, symmetric concept to inflation that bothered dollar's bull. The U.S. economy may have created fewer jobs than expected in April, but the unemployment rate remains at record lows. Wages growth disappointed, but at least they keep on growing steadily for a year now. Much of the dollar's rally can be justified with easing geopolitical tensions, but when it comes to the EUR-USD pair, is also about the common currency. The final market PMI showed that despite still in expansion territory, the economic growth has kept decelerating at the beginning of the year. More relevant, inflation has been a huge disappointment this week, as it unexpectedly weakened to 1.2% in April, according to preliminary estimates, while the core rate resulted at 0.7%, the lowest advance in more than a year. That means the ECB will stay wary on monetary policy, and hopes that ECB QE will end by September, have now diluted. The imbalance between central banks is once again a relevant factor, as long as geopolitical concerns remain subdued. Data in the UK and jitters within May's cabinet helped the dollar rally, a situation that replicated in other economies, with weak data putting different currencies under pressure. The upcoming week will be lighter in terms of relevant macroeconomic releases. U.S. inflation next Thursday is the most relevant news scheduled, seen up 0.3% monthly basis against the previous minus 0.1%. Core yearly inflation is forecasted at 1.9% from previous 2.1%. At this point, we can't deny that the dollar's advance seems a bit overstretched and that hopes for a tighter monetary policy may be too high at this point. But chances are of a continuation rather than a reversal, and pullbacks will be seen as buying opportunities. EUR-USD technical outlook. The EUR-USD pair weekly chart shows that the strong momentum that begun last week has accelerated, with the price moving further below its 20 SMA, and technical indicators heading sharply lower with a negative territory, as the pair ends the week a handful of pips below a new 2018 low of 1.1910. The daily chart presents a strong bearish bias, as the pair extended its decline and is now some 100 pips below the 200 DMA, the first time below the indicator in a year, while the 20 DMA heads sharply lower below the 100 DMA, both far above the current level. Technical indicators in the mentioned chart have resumed their declines within oversold levels, with no signs of downward exhaustion. The break of the 1.2100 level has been key for this ongoing bearish trend, and while an upward correction is not out of the table, further declines should be expected. The next relevant support, on a break below the mentioned low, is the 1.1840 region, where it presents multiple daily highs and lows from 2017. In the longer run, a break below this area should mean a possible test of the next big support, at 1.1660. The 1.2000 psychological threshold is the first resistance for this week, with an intermediate one at 1.2060 en route to 1.2100. This last is quite relevant, and in the case it gets tested, selling interest will likely defend it. Out of the table, for now, the 1.2160 is the inflection point, as the pair would need to settle above it to turn bullish. EUR-USD sentiment poll. The FX Street Sentiment Forecast poll paints a mixed picture at a first glance, as sentiment is bullish weekly basis with an average target of 1.1961, but bulls account for just a 36%, with banks being clearly more bullish than traders. Bears represent a 32%, while those undecided also account for the same amount. But taking a look at the overview chart, the moving average has turned sharply lower from the previous week, indicating that sentiment is much more bearish than what the average represents. The same goes for the monthly view, where bears are a majority of 53%, although there's no clear target there, with a high degree of divergent perspectives. Longer term, faith in the greenback decreases, with bulls becoming a 50% unchanged from last week, and the average target also flat at 1.2037. This last is rather reflecting uncertainty rather than anticipating a recovery, a situation that persisted for the last couple of months.